Hey, everybody. Welcome to the AOF Real Estate Show. I'm Drew Kardash, here with my co host, Kevin Rohoman.
Hey
And
guys.
today's a special episode. We have a guest here for the first time. We've got Matt O'Rourke from GreenBirch Capital here.
Thanks
And
for
we're
having me.
going to thank you, Matt. We are going to talk about all things CMHC MLI Select. But before we get going, Matt, do you want to take a few minutes and just tell our listeners who you are and how Greenbirch Capital fits into the program?
Yeah, absolutely. So first, thank you very much for having me on today. GreenBirch Capital, we are a commercial mortgage brokerage. We're based out of Calgary, but active across the country, save and accept Quebec. And a lot of the work that we have done has been with CMHC insured financing, and specifically in the last couple of years since the Select program has been launched. That's where a lot of investor and developer demand has gone, just because of some of the benefits that program offers. Prior to brokerage, I spent almost 16 years with a bank doing real estate lending across the country, from construction through to term lending on just about every kind of asset class.
Awesome. Awesome. So, a lot of our clients, a lot of our listeners understand or have a good understanding of what the CMHC MLI Select program is. But for those of those clients who don't understand or have just heard about it or just hearing about it for the first time, can you kind of give a Coles Notes explanation on what the program is and how it differs from conventional commercial financing?
Yeah, absolutely. So ultimately, CMHC is providing mortgage default insurance. So it ultimately protects the lender, so that if a CMHC insured deal were to go sideways for whatever reason, the lender would have to go sell the property, go after the owner for the guarantee. If that was not enough to cover the outstanding loan amount, the lender would be able to submit a claim to CMHC and, in theory, have that insured, protecting the lender from incurring a loss. What that allows lenders to do behind the scenes is ultimately put much less capital aside against those insured loans. You effectively have the federal government through CMHC backstopping these mortgages. So a borrower is going to pay that premium to CMHC, but that benefit ultimately lies with the bank. The trade-off is lower pricing. There's typically about a 1% discount on a CMHC insured rate for multifamily versus a conventional rate. The other big benefit is CMHC does offer longer amortization. So conventional lending, you're probably going to be limited to a 25, maybe a 30-year amortization. And again, you're probably going to see about a 1% premium over a CMHC insured rate, give or take. So for the case of, say, like MLI Select, if you're looking at, about a 3 to maybe a 5% premium that's paid to CMHC, your interest rate savings in a 5-year term are going to offset the cost of that insurance. And then you still have the benefit of anywhere from, maybe 40 to 45 years of remaining insured life, where you're going to continue to get that ongoing cost savings.
Amazing. Kevin, I know you've got some questions. Why don't you
Yeah,
ask away?
absolutely. So, like, one of the big things when talking to potential clients about this is they want to know, what is the qualification process? Like, how does this work? How do I get started? The thing that usually gets them the most excited is potential for a lower down payment.
Yeah.
But how do they get started? And what is the qualification process like?
Yeah, great question. I'll break it into kind of two distinct components, if you will. One is the ownership group, whether it's an individual or a group or whatever it may be. An ownership group is going to have to provide a guarantee that where they've got a net worth that is at least 25% of the requested loan amount. So that's kind of the minimum starting point. So for a lot of our shared clients, that's often where we'll start, is by vetting net worth to make sure that we can arm someone with good feedback in terms of how much they should be able to qualify for just based on their net worth. That way, when they're out shopping, there's at least a good understanding of what a realistic deal range may look like, or what size transaction, they may need to look to partner with someone, or, come up with other options. The second piece is property specific. So for any kind of commercial financing, a lot of the work is drilling down into how much income the property produces or is expected to produce if it's new construction. So that's looking at good rental comps. It's understanding how to underwrite operating expenses the way CMHC will look at it. And if it's new construction, really getting a good quality appraisal to show what a realistic level of income the property would produce if the building was completed today. That income is, really drives both valuation as well as how much debt a particular property can service. So, a lot of people hear, MLI Select, you can get up to 95%. It's not a guarantee you're going to get 95% leverage. That is completely dependent on how much income the property produces and where interest rates are at that particular time. And specifically to the Select program, I'll just launch into this a bit. CMHC has their standard rental housing program that's been around for decades. That can get up to 85% leverage and 40 to potentially 50-year amortizations. But there's no requirement for any kind of social outcome. That's just sort of, I would say, CMHC's bread and butter product for years and years. The Select program was specifically launched a little over 3 years ago, March 2022. And it was a series of, I'll say, enhancements that allowed for up to 95% leverage and up to 50-year amortizations. However, property had to meet certain social outcomes. So it could be affordability, energy efficiency, or accessibility, or a combination thereof. And effectively, a property would have to meet either a 50, 70, or 100 point level to drive a 40, 45, or 50-year amortization, respectively. So for Alberta, specifically Calgary and Edmonton, the main benefit has been, or the main social outcome use has been affordability. In Edmonton, an affordable rent is considered $1,665 a month or less. In Calgary, it's $1,737 a month or less. So for a lot of new product, you can still have market rents or slight discount to market rents and make that affordability work. So if you have 25% of your units in a new project as affordable, that would max out your participation in the program and drive a 100-point MLI Select deal.
Yeah, and obviously you guys have easily done the most deals for us. So a lot of the types of offerings that we bring, we hit that affordability matrix right away. So we're at the 100 points. So it really comes down to how much money the offering is bringing and generating. And so for you guys, how long does that process take to assess a deal? So let's say client calls you, the net worth component, I'm sure you can verify that within a couple days. How long does everything else take to kind of really assess a deal before someone can move forward?
Yeah, great question. We try and get feedback on properties to people within a couple of business days. Fully cognizant that, once someone's made an initial deposit on a property, they have that conditional period to get through their due diligence. And what we really want to make sure is we can do is confirm how much we expect the property to generate in income, get some soft feedback from an appraiser. So it's not just our view, but we are getting some level of external support in a very short period of time to try and make sure that a particular purchase price and range of loan amounts are realistic. Present that feedback back to a client so they can ultimately decide if the loan to value and if the cash flow makes sense for them, as well as vet their net worth and make sure that they can comfortably meet or exceed that particular 25% minimum requirement.
Perfect. And I've noticed a difference, when I have clients talk to some other lenders versus talking with you guys, when those lenders don't have a lot of experience in Alberta or doing a lot of these deals, it seems like the information's a little bit different. Are you guys able to drive a lot of the information that you can give a client from past deals that you've done?
Yeah.
So you kind of learn from that?
100%. And
okay.
CMHC has had policy changes. The MLI Select program has gone through multiple changes in the last several years. We earlier this year, we crossed 250 MLI Select deals approved and funded to date. So we have a steady flow of deals. So we do have, I would say, fairly constant and real-time feedback coming in terms of exactly where CMHC is or lender appetite, things that may impact, a particular type of transaction.
Yeah, it seems like you guys are always on the pulse with that. And I guess that's a good time to talk about some of the misconceptions of MLI Select. We're hearing different stories from different people, a lot of confusion. So the basis of this podcast for having you on is to make sure that everyone's clear about what they're going to get when they do MLI Select, what they don't get, how does this work, and what types of property types work. I know that's been changed recently as well. So would love to hear more about that.
Yeah, for sure. So I'll go back to a couple of the changes. Earlier this year in February, there was some clarification that CMHC issued, specifically defining what qualifies as multifamily for CMHC insured purposes. One of the things that really seemed to be designed to do was disallow or sort of discontinue assemblies of single family homes that would have had like adjacent lots to be sort of assemblies that could be bundled and qualify for CMHC insured financing. A lot of those transactions had gone through for years. CMHC seemed to view that as an exception. And I think ultimately, they were looking at how much they were insuring. I think trying to pare back how much product they were insuring. Their view for the single family home investment product is they had another solution more for residential mortgage product that could be used to kind of potentially suit that need for certain investors. In the last couple months, what we saw was some additional clarification around secondary suites. So again, a lot of this in Calgary and Edmonton, where you've got, say, like 4 or 5 townhouses in a row, and then all of them have legal secondary suites. One of the main things that CMHC wanted, or a couple of the main things CMHC wanted to really better understand was how are those properties set up in terms of utilities? Are there independent water, gas, and electrical lines to each upper and lower unit? Or do you have a single line coming in where an upper and lower unit are sharing? If that's the case, that's fine. But what we have to do is make sure that the rents are inclusive of utilities in that particular case, and that we're underwriting an appropriate utility operating expense as part of that sort of cash flow modeling and driving valuation. The next thing that CMHC really wanted to see was that if you have an upper and lower unit, understanding how the mechanical rooms are set up and how they're accessible by each tenant. So the main thing they would want to see is either independent mechanical rooms, upper and lower, or if there is a shared mechanical room, that each tenant could access the mechanical room without having to go through another unit. So, simple case would be if you're the upper unit, if you couldn't access the mechanical room without going through the lower tenant's space, you could have a problem if that lower tenant were gone for a week on vacation or something.
Absolutely, yeah.
So, to be honest, I think most builders who were, designing this kind of product, I think for the most part had that somewhat contemplated from, I don't want to say a common sense standpoint, but it makes functional sense that each tenant would have independent access to, electrical panel, hot water tank, furnace, whatever. Just so if a service call was needed or a breaker flipped, there's quick access for anyone.
Yeah, and that's like, it's funny. We were actually making these changes before CMHC did. We're constantly talking to property managers, homeowners, and figuring out what is their pain points. And having the mechanical room in the one suite was always something that was coming up. So we've actually started making changes even before these changes happened. So it just kind of lined up perfectly. So our offerings, like our new construction multifamily deals, fully are inclusive now of commonplace mechanical rooms, or if there isn't that option, there is the sub metering, the separate sub panel in the individual suites. So we've found a way actually to successfully comply with these things without actually having to make any changes. So any of our clients that are actually pending on deals and the changes happen, they're not affected. So we're really happy that we were kind of proactive on that change. So if you're looking for a MLI Select deal, you can be confident knowing that we already have this well thought out. We have it set up. GreenBirch, if you're looking to get in touch with them, we can definitely connect you. I know Drew was going to point out the best way to reach out to you guys so we can go through that whole process, get you started, find out if you qualify. Obviously, we have the deals. So if there's a property type that you really like and you want to see how that works with GreenBirch and the MLI Select financing program, we'd be happy to connect the dots for you on that. And then figure out, like, I call this still, even with all the changes, the best financing in the world. If you can qualify and you're buying one single family home with a suite for 20 or 25% down, you can utilize that same capital and buy a multifamily building. So there's just a lot of reasons to explore that first before you go down that route, and have your less money do more for you, essentially. So the guys at GreenBirch, their website also even has up-to-date mortgage rates, I believe,
Yep,
on the bond yield rate. Maybe you
exactly.
want to touch on the bond yield rate, on how that works, because I'm sure a lot of people are going to be heading to your site to see how the
Yeah.
interest rates fluctuate and all that.
Yeah. So any CMHC insured term debt is generally priced off the Canada Mortgage Bond, or the CMB. And that's the specific kind of bond that CMHC issues. So mechanically, the way this would work is CMHC will run 5 and 10-year bond pools multiple times a year, and they grant allocation in those bond pools to CMHC approved lenders. So what we do is, shop our deals out to those lenders, get the best terms and pricing for our clients. And essentially what happens is those lenders are going to fill their allocation, and then CMHC will warehouse and securitize and create a bond with thousands of these mortgages several times a year. And then ultimately get a debt rating on that bond, sell it off to global investors, and that's sort of the mechanism that's used. But the Canada Mortgage Bond is it's a tradable instrument. So it's like a Government of Canada bond, but has a slight premium to it because it's being issued by CMHC, not directly by the federal government. But that is the basis where it's going to be the Canada Mortgage Bond plus a spread is going to be the pricing on any deal. Generally speaking, the larger the deal, the better the pricing. So what you can do is, if you go to our website under the resources section, so GreenBirch Capital, you can see sort of a 5 or 10-year Canada Mortgage Bond chart and see how the bonds have moved over the last day, 5 days, month, or up to 3 years. So people can get a good sense of, if you hear about an inflation number or a jobs report, those kind of macroeconomic data points that will move the bond market, you'll see how the bonds have kind of reacted over time, and just kind of hopefully understand that the interest rate is a key factor in these deals, but it's beyond all of our control. So it's not to try and pick the perfect time to do a deal, but just kind of understand what a reasonable range for interest rates could look like over a certain period of time.
Perfect. Well, you really know your stuff on mortgage bond rates. That was awesome. A deep dive into that. I guess the last thing I wanted to ask you, if someone wants to buy these places, I know it's obviously different than buying a residential property. You get your mortgage letter of approval and you move on. For these deals, they're bigger. They take a little bit of time, usually 10 to 12 months. So you can't actually do a full mortgage approval letter at the time when condition removal is. I know you guys do something called a comfort letter or something like that.
Yeah.
Can you go into how that works and how that's supposed to help a client make a decision if they want to move forward or not?
Yeah, 100%. So the comfort letter is really just, I'm going to say it's sort of a summary, but like I said, the two key aspects to any deal are understanding the ownership's net worth. So that's going to be one thing that we're going to do to make sure that, making up a number, someone's looking at a $4 million deal, the ownership group's going to have at least $1 million in net worth outside of their ownership in that property. So that's kind of one piece we can start with and run their net worth to make sure that, however they have themselves structured, what they own, what they owe on different assets, is all sort of taken into account. And we can give pretty quick feedback that, we viewed your net worth, you should be able to qualify for up to X. The second piece is doing that cash flow analysis on a property. So again, running through the numbers, looking at where current rents are, getting some feedback from an appraiser, and then factoring in a bit of a sensitivity on how the loan would look today based on current interest rates, but then sort of showing what could happen if interest rates were to move up or down, so that we're at least demonstrating how the loan amount may change if interest rates shift from, say, waiving conditions with a builder today to that product being delivered in, like you said, 10 to 12 months. But part of this is a just a frank conversation with any purchaser to say, interest rates are beyond our control. So if you waive conditions today, based on everything, we would expect you to qualify based on, current CMHC policies, based on your net worth. This is a realistic range of potential outcomes. But there's got to be a level of comfort, and there's a level of risk an investor's taking where, because that product's not going to be delivered for 10 to 12 months, there's got to be an open conversation and just honesty to say there are aspects of this process that are beyond any of our control. So there has to be a level of comfort to take on a certain amount of risk over that period of time.
Yeah, and like you guys look at different contingencies too. Like it's not just like here's the interest rate. You look at if the rate goes up a little bit, also if the rate goes lower. So it's really painting the full picture on, hey, these are your different scenarios, and then it's up to the client obviously on if they feel comfortable after all the assessment of the property and whatnot, to move forward. So I really like that you guys are so thorough with that and you're giving them different options, not just the best case scenario on how this would work, but also like a worst case scenario, so you can really test this property and see if it's a good fit for you.
These are major investments that people are making. This isn't about trying to sell a product. It's really trying to make sure that people understand what's involved at each step of the process, so that ideally people are going through this with as much information so that they can make informed, confident decisions and not have anything catch them by surprise.
Yeah, and that's why confidence is key. Work with an experienced commercial broker that does MLI Select, because that confidence, they can pass along that confidence to you. They know when it's a good deal and when it isn't. And the same thing for us with Alberta on Fire. We've been doing these new construction multifamily deals since before MLI Select, but it obviously amped up once MLI Select came through, and we are the experts in this. We know it, we breathe it, we deal with it every day. We've done hundreds of these deals, and a good deal of those deals have been with GreenBirch Capital. So thank you so much for taking some time. I think we'll probably, if our listeners really like this, we'll get you back on and maybe do a deeper dive on the program and maybe some examples of deals in the past, so we can paint that picture for anyone who's interested. Drew, how's it going, buddy?
It's going good. Thanks so much, Matt. Your insights are amazing. Appreciate your time. Like Kevin said, thanks for joining us. And what is the best way to get a hold of you?
You can find us on our website. You can email me directly at matt@greenbirchcapital.ca, or sorry, greenbirch.ca. Or obviously connect through you guys. Anyone who's looking at a specific transaction, happy to jump on and start this process in terms of net worth and property analysis anytime.
Awesome. Well, I know you're busy, guys, so we're going to let you go. Thanks again for coming on here. Thank you, everybody, for tuning in. And until next time, take care.
All right, bye, guys.
Thanks so much, guys. Take care.